All right, first of all, this is not financial advice. This is just my opinion, and this is what I am doing. This is what I have learned, and this is my own strategy. It's worked out in the past for me pretty well, but I'm hoping this is going to be the best strategy to maximize gains and make some life-changing decisions. Now, first of all, the richest people in the world, they became the richest people in the world during times of turmoil. So when an economy or stock market falls and there's blood in the streets, that's when you buy. Okay? And here's John D. Rockefeller. The way to make money is to buy when blood is running in the streets. He's one of the richest men in history. All right? And same with Warren Buffett and the rest of them. They see opportunity when everyone else is getting slaughtered. Now, obviously, it's just not that simple. You have to know what and where the opportunity is, right? So there's a lot of research, fundamentals. You have to know macroeconomics, macro trends and cycles. We'll talk about that. I'll show you guys. And when things change in a big way, that's when the opportunities are there for the taking. So in a world full of endless money printing and fiat, right? And this is global. There's global riots right now all around the world because people's standard of living is just falling and falling. And the smallest thing sparks it, right? They're all around the world right now. It's just not in the mainstream news. But if you pay attention, it's everywhere. And there's a reason why they don't, put in the mainstream so there's no panic, right? But we're starting to come to an end of a macro cycle in credit expansion and growth. And you guys know that, who've been listening to me, right? If you're new, I'll talk about that later. But fiat currencies, they're dead. JP Morgan, what do you say? Gold is money, everything else is credit. What is credit? Credit is debt. Debt plus interest. Technically, it's a Ponzi scheme, and that's what it's become. So let me show you guys some visuals here so you guys could get the idea of how serious this really is, because I don't think most of you understand the size of the wealth transfer and the possibilities. All right, so here's $20 trillion visualized in $100 notes. So here's $100. Here's $1. Here's $10,000. I've seen it in real life. A lot of you haven't. Here's 1 million. This is what 1 million cash looks like. Here's 100 million. What cash looks like. 1 billion. 1 trillion. That's the White House. Here's a truck. There's a jet in the background. So you guys get a visual of this. Still, 1 trillion. There's a football field with a jet on it. Now, 20 trillion. What does that look like? $100 bills stacked on top of each other. This is what it looks like. That's the Statue of Liberty. Here's a huge crane. All right. Let's carry on. Here's the global debt of nations, right? Here's Russia. That's their debt. They're almost out of debt though right now. This is so what I'm showing you guys right now, it's a little outdated. It's like 4 or 5 years old. So technically the cash is, I wouldn't say double, but it's at least 30% more. So whenever you see this cash, just add 30% to it. I'm dead serious. With derivatives and all that. Here's China. Here's Brazil. India. Taj Mahal right there. Here's Big Ben. United Kingdom for England. Here's all the cash right here. Here's France. There's the Yellow Vest movement, right? Riots. Why? Look at all this debt. Well, what does debt have to do with the economy? I mean, it's very simple. It destroys the real economy. Here's Italy. Colosseum. Germany, United States. Now, this is just the debt of the nation. It's not, it doesn't include private, doesn't include the banks, doesn't include corporations, and it doesn't include liabilities, all the money that's owed for like Social Security, Medicare, welfare, all that crap, all the empty promises. So this is just, the current national debt. So technically, it's much more. So let me show you guys some more visuals. Here's the wealth of the current, richest people. Warren Buffett's over here, Bill Gates, and Carlos right here. World's biggest companies. This is what they're worth. This isn't their debt. But their debt is... it's different for every company, but this is what they're worth, all right? And their stocks are extremely overvalued. Extremely over. PE ratios never seen in human history. Or PE ratios is price earnings. These companies, their stock value, their market caps are in the billions. Apple just became $1 trillion, right? So look at this. ExxonMobil, $330 billion. Berkshire Hathaway, $330 billion. Microsoft, $470 billion. Google, $500 billion. Apple, $550 billion. Now, keep in mind, this is like 5 years old, these visuals. So now it's $1 trillion for Apple, and Google's probably getting close to $1 trillion. So you could almost double these. And soon we're going to have $1 trillion corporations, according to their market cap and stock valuations, were extremely overvalued. All right. And that's because of central bank policy, artificial lowered interest rate, fractional reserve lending, and endless money printing, technically, right? Ponzi. What's his name? Bernie Madoff. Before he went off to jail, he said, if you guys think what I did is a Ponzi scheme, just look at the dollar in the banks. All right, guys. So all investment, gold and silver in the world. So cash value of investment in gold is 2.5 trillion. That's what it looks like in cash. Technically right now the metals market is 7 trillion. Again, this is old. This is 5-6 years old. So pretty much double everything except metals. Because the amount of metals that come into existence every year is like 2%. So this is all the gold in the world. This is all the silver. And I'll show you guys some more pictures. Now check this out. This is the money supply. Base money supply, 28 trillion. Bank money, 50 trillion. That's what it looks like. Here's the Statue of Liberty down here. Here's the Fed. I've actually seen it at well, no, that was Fort Knox. Okay, but I've never actually seen the Fed building. But double this, what you see right here. So these are $100 bills just laying on top of each other. And this is just the money supply. Now, I wish with these visualizations, they took all of the money, which is including the base money supply, the cash the banks have, all the stocks in the world, all the derivatives, and all the government debt. And I wish they did a visualization of that. Who knows what that would look like? It'd probably be a size of like, I don't know. It would be huge. It'd be bigger than the entire like city of New York. But we have some more visualizations here. So here's what 1 ton of gold looks like, 2,000 per ounce. It's worth $64 million. That you could drive around with a pickup truck carrying around $64 million. This is what it would look like in cash, though. It's like a pallet. So this is what I wanted to show you guys. Here's the entire gold reserves of the United States government. Well, no. This is the entire reserves of all of the central banks for each country, right? So United States right here, you can see a little man standing up there, right? Let me zoom in. Give me a sec. Here's Germany, IMF, International Monetary Fund. This is interesting because this is like the globalization bank, right? The global bank. This is the central bank of all the central banks. And look at how much gold they have. So I kind of view it as they've been robbing the public in the countries of their wealth. All right. And I'm going to talk about something that's going to blow your mind in a little bit. Here's Italy. Italy actually has a lot. France, they do too as well. Russia's down here. Russia now, you could double this because Russia and China have been buying. Here's China next to France, but you could double this easily, if not triple it, because nobody really knows. All that everyone knows is they've been buying. All central banks have been buying since 2008, since the mortgage-backed security crisis, right? Because they're preparing, because they know that they're going to print. And it's the only option they really have. I'll talk about that later as well. Iran, European Central Bank. Check this out. They actually have a decent amount as well. So these two entities right here, those are the globalists, right? And they've the way they've gotten these metals is through the paper markets manipulation, and they've taken it from other countries. And that's another wealth transfer before the large wealth transfer. So all these central banks have been buying up gold, hand over fist, for the past 10 years because they're preparing for the largest wealth transfer in human history as well. Because there's going to be a revaluation of precious metals versus all of the fiat that's been printed. And it's going to, more and more is going to be printed. I'm going to talk about modern monetary theory. And all the debt, all the derivatives, banks' balance sheets, the corporate bond market, right? And then the bond market, which is much larger than the stock market and all that, right? So what else do we have here? So technically, this is all the gold in the world. Visualize. Here's a house. But listen, this is actually smaller in real life because there's a lot of space between it. I actually wrote that in there as well. And I'll show you guys a real representation of what it really looks like. So this is actual size of all the gold in the world, compressed. So you could get a real sense of how much there really is. Now, granted, this was a while ago, 5-6 years ago, 4 years ago, something like that. So this is maybe a little more, but not much, nothing noticeable. Now listen, that's not a lot. And people who actually have physical right now, and they can hold the coin in their hand. Now think about it. If you could go out and with like $20,000, buy a decent amount, you could hold it in your hand. It's heavy. It is. And compared to this big block of gold, it's not. It doesn't seem like much, but it is. If this is the world supply, you're just one human being in a world of what, almost 8 billion people? Or is it 9 billion? I don't even know anymore. So this is going to be, this is money. It's not going to be. It always has been money. This was the world reserve currency. It always will be. This is wealth. And I'll explain to you in another video, and I'll touch base on it again in this video, why it is. But listen, if you're holding a handful of gold, you're in the top 1% of the world. You are 1%. If you have like probably just 5 ounces, you're 1%. And you will be in the future. Right now you're not, but you will be possibly in the future if we have a huge monetary global reset. And we will. That's it. You're already 1%. During Weimar Germany, when they went into hyperinflation, 1 ounce bought you a entire city block. Now, I don't think it's going to get to that point, but you never know. I mean, we'll see. We'll see. I'll talk about expectations of how much it's going to go up versus the dollar, all right? And other fiat currencies. I'm not done yet. Let's see what else I have here. So, listen, we're going to go into a huge super cycle in gold. I will post this in the free chat group. Links below this video in the description. Check out all the links. Also, check out, I have a link there. I get a kickback if you go to Monet. You could buy bullion jewelry. It's great for the holidays. I get like a little bit of a kickback, nothing crazy. But if you guys want to buy jewelry, I suggest you buy bullion jewelry. And it's affordable, and it'll be money. You can melt it down. It's like 90, I think it's like 24 carats, or it's like 99.9% physical gold jewelry. I think they're going to add silver as well. And it's great for travel if you need to get out of a sticky situation, if you know what I mean, because they can't confiscate it. You get on a plane. Just saying. You might want to look into that. Another strategy it's gold. It's a little golden nugget for you guys. So if you ever want to get on a plane, get out of Dodge, you could wear all the jewelry you want. You can't do anything about it. So, you know, global debt's exploding. It's way past 250 trillion at this point. It's actually, I've seen numbers around 4 quadrillion, including derivatives. But if you don't include derivatives, which it might just go up in smoke and it might just disappear, so it's not actually going to transfer anywhere, but the rest will transfer. So financial corporations, government debt, non-financial corporations, and households. This is all the debt in a chart. It's going up to 250 trillion. That's with a T. So how much is a trillion? That's 1,000 billion. All right, guys. That's why I wish there was a visualization chart of all of it. But I don't know what it would look like. It'd probably look like just New York City, except in paper, in $100 bills stacked. Or if you took the entire world, right? So, yeah, I mean, it's actually probably towards 1 quadrillion. So 250 trillion is a quarter of 1 quadrillion. I mean, people can't wrap it around their heads. I don't think I can either. So, all right, guys. All major currencies have depreciated relative to gold. True. Let me show you guys a chart. I'll talk about that in a second. Here's all the world currencies. Well, okay, so they're going higher because this is gold versus the currencies. So I just color coordinated them. The green is the dollar. As you can see here, world currencies are depreciating against metals. Now, let me explain something to you guys. The dollar is the strongest right now. Today's date is October 23rd. Other fiat currencies around the world, they're at all-time lows against metal. So gold is at all-time highs already around the world for every other country except for the US. All right? It's 2019, October 23rd. All right, so here's one visual I just want to show real quick. Hong Kong, see this right here? This is Hong Kong. Right now, there's turmoil in Hong Kong. It's actually a fairly large exchange in the world in clearing. There's a lot of money that goes through it. That's actually the reason I think Hong Kong is being taken by mainland, right? All right, check this out. World silver reserves. That's not a lot, guys. This is a house. This is a semi-truck. This is a human being. This is all the silver in the world. So if you have like 10,000 bucks right now, you could buy a monster box of silver, which is it's like a crate, a milk crate of it. Now think about that. You could right now have a milk crate of physical. All right? And that's compared to the world reserves. And that's not it, guys. Hold on. Here's all the silver. Silver currently in existence. This is in existence. All right? Now, it's much bigger than the house. And it's bigger than the world, all the gold in the world over here, right? But it's not that much bigger. Now, think about it this way. Now, this other block of silver to the right here, this is silver lost throughout history. And then this is all the gold mined in history. And this is a house. So if you have a crate of silver, you're 1% again in the future, in the near future. Next 3, 5 to 10 years, you could easily be the 1 percentile, the richest in the world. Do you understand the wealth transfer now? Visualizing this stuff. Here, let me blow it up a little bit. Look at that. All right, this is a person sitting on a couch. All right, so remember, this is all the gold in the world. All right, so remember, this is all the silver in the world, just this block right here. Now, let's take a look. Let's visualize the size of the world markets and everything. Here's silver, this little dot. Here's cryptos, but they're much smaller now. Biggest companies: Berkshire, Microsoft, Alphabet, Apple, Facebook, Amazon. Look how much bigger they are than the entire silver market. And then gold is even smaller than silver, remember? It's like half the size. Not even. It's like one-tenth the size. And I'm going to talk about the silver to gold ratio as well. Because usually gold is... The ratio is somewhere between 1 to 15, 1 to 10 historically, but it's more like 1 to 15. But silver's been depleted, so there's much less nowadays. So that's silver. Here's all the major companies. 50 richest people, California's GDP, Fed's balance sheet. Again, these sizes are increasing already. This is old information. This is outdated. So you could just add maybe 30% to all of this, except the metals. Here's all the currency. That's with jewelry. But it's not, this isn't the actual size. All right, so here's the stock markets. United States is blue. UK, Japan, China, Euro area. Rest of the world is black. Global money supply. Look how big this is compared to the rest. Global debt, which debt is money, so this is gonna get transferred somewhere. If even 5% of this transfers into precious metals, like, the price is going to explode. 5x or something. I don't know. Because the world's never seen so much debt before, so we don't know. And this is only 70 trillion. Right now it's at 200. No, it's more than 250. It's, like I said, it's exponentially increasing the debt year over year. With the derivatives market, everything. It's really like 1 quadrillion, so it's much bigger than this. Visualization. This is an old article as well. Global real estate. Look at that. It's huge. Wealth's going to transfer out of this as well. And this is in dollars, right? Just a visualization. Derivatives. Here we go. I'm still scrolling. Look at this. I'm still scrolling. Still scrolling. Nuts. Look at this. I'm just still... This is insane. Look at that. I'm still scrolling. I'll post these in the free newsroom. Alright? Let's take a look at a few more visuals so you guys really get this. These are banks and all their what they're worth. Oh, this is derivatives exposure, not what they're worth. So, well, technically what they're worth is also their derivatives on their balance sheet, but it's really liabilities. All right, so this is their derivatives exposure, which is like a casino of betting, basically, of phantom money they've made up. State Street Financial, Morgan Stanley. Look at that. This is their building. Skyscraper. What is this? Wells Fargo. Check this out. Look at that. They literally at derivatives markets, $100 bills stacked of casino money that they're just gambling with, which is essentially debt. And if you stacked it, I mean, it can be higher than their own skyscrapers in the major cities. HSBC, Goldman Sachs. Look at that. Goldman Sachs. Bank of America. Look at that. Citibank. Look at that. Now, again, this is outdated, so give or take a few of these skyscrapers of $100 bills. This is the White House down here. This is Chase. And right now, the repo market's blowing up, right? Which should never happen. It's technically supposed to be impossible. But this overnight lending and the central bank right now is literally just printing money, adding it to their own balance sheet, calling it not QE, and saying, oh, they're just providing liquidity. Because the banks don't trust each other. Something big happened. Something blew up. We're going to find out soon. And this is probably the canary in the coal mine, or the first domino to really start the domino effect of the house of cards coming down. Again, October 2019, 23rd. All right, guys. A few more visuals so you guys get it. Again, this is silver, gold. The ratio, the gold to silver ratio right now is at 85. It hit 94. So current date, right? Now, every time the ratio goes 80 to 1, so 80 ounces of silver to 1 ounce of gold, precious metals go into a bull market, like a decade-long bull market. It just hit 94. Currently, it's at 85 today. So that ratio needs to, I mean, it's widened to the point where we've never seen it widen. It needs to narrow. So what does that mean? Historically, 10 ounces to 15 ounces of silver should buy you 1 ounce of gold. Now imagine this. The price of gold goes to $10,000, 1 ounce. And right now, you could buy, with 1 ounce of gold, 85 ounces of silver. So right now, you should probably be heavier on silver because it'll buy you more gold. Now, if the price of gold goes to $10,000, right, and you right now took your gold, bought a ton of silver, this range is going to narrow. And when it gets back down to 15 ounces of silver could buy you 1 ounce of gold, imagine the gains. It's just compounding gains. And that's just talking about physical. I'm not even talking about silver mining stocks. I'm not even talking about that yet. So think about it that way. So right now I'm heavy on junior silver stocks personally. I'm going to buy some more physical as well because think about it. The price of gold goes, let's say, to $1,000. Well, that means that silver could easily go to $300 an ounce. Currently, it's like at $16. All right, guys. Here's a more recent, this is 2015 visualization of the United Nations of debt. So all of the countries and the debts they've accumulated. But this is just current debt. This doesn't include the unfunded liabilities. So the promises, Social Security, all the pensions, all of those promises. And a lot of the pensions as well, right? They're all invested in the stock market. So when that falls, what they're going to have to do is print. Because if they don't print, then you get riots and like revolutions, pretty much. But that's already happening right now in the third and second world nations. Right now, there's at least 12 to 15 where there's some sort of civil unrest and uprising in the third and second world nations all around the world right now. Today, 2019, October 23rd. So, at face value, United States has about 30% of the world's debt. Japan has 20, China has 6. But like I said, this is 2015. It has much more debt now. Their debt to GDP is pretty bad. No one's is as bad as Japan's, and that's why Japan, since their housing bubble in the early 90s that popped, they've been in a stagflationary depression for essentially 2 decades now. So, obviously, the United States is proportionally outproportioning the rest of the world in debt. And the United States economy, though, if you take away the financialization and the government spending, essentially, can't. If you take away all of the government spending and the financialization of the economy, the United States economy is much smaller. According to Austrian economists, you would want to look at productivity, and productivity is manufacturing, right? It's making things. Because the United States doesn't really export much services to the rest of the world. So if you look at the U.S. as a corporation, not just some country, um, they don't export much because we don't make anything. We can't export our services. All we do is export debt, which is our dollars, and then collect interest on it, kind of like a bank. Um, Natural resources, the U.S. is pretty rich in that. So self sustaining it could become, although regulations, endless regulations of red tape and high taxes, of course, make the U.S. not competitive on a global scale against China and emerging markets, which is third and second world. So the U.S. economy's debt is much, much, much greater than its actual GDP size. If you go to nationaldebtclock.org and you actually look at these numbers in detail, and I highly suggest you do that so you can see it for yourself, it looks bad. It looks really bad. Now, these obviously this isn't absolutely accurate. There's no way it could be, but even if it was 10% off, it doesn't matter. That's how bad. It's how far gone it is. The unsurmounting debt, what it does is it destroys the economy because you can't have growth. Think about it. If you're indebted, you have to pay off your debts before you could grow again, before you could grow your company again. So, as a nation, as all the corporations and even private individuals, they have no savings, they only have debt. They can't grow. Yes, you can use debt to grow, but you have to have a steady stream of your revenue, and your profit has to outstrip the interest and the debt accumulated. You can't live off of credit cards. Right now, like I said, the trade deficit's enormous. The U.S. doesn't export all that much. That's the problem from an Austrian perspective. All right, so let's look at this chart right here. The S&P 500 versus the Federal Reserve balance sheet. As you can see, as the Fed's balance sheet starts dropping, so will the market. When the balance sheet rises, the market rallies. It's that simple. Where do you think all the cheap money is coming from to push stocks higher and higher? Do you feel richer than 10 years ago, 20 years ago? Are your neighbors richer? Not really. Everyone has more debt, but they're not any much better off. I mean, cost of living, everything has gone up, right? So that's what pushes the market up because that money finds its way, right? Through open market, through bond selling. The banks get them. Well, the government gets the money first. The banks get the money first, and then the banks can lend it out. They lend it out to corporations. Corporations then take that money and buy their own stocks instead of reinvesting it into their own corporations to grow their corporations. Um, and that's another ticking time bomb. So that's what happens. Malinvestment happens everywhere because everyone's chasing yield. Corporations aren't expanding their businesses because there isn't a market to sell to. I guess you could build it and they will come, but corporations, I mean, they're just zombies. They're becoming over bureaucratic zombies, essentially. And people aren't buying as many products. So instead of making more products, more innovation, a lot of them, they take a lot of that capital or they take that loan money and then they buy back their stock shares. CEOs can then, sell their stocks and then glide away in golden parachutes. All right, I've shown you this chart, the debt. I've shown you the depreciation of fiat currencies against metal. People think the price of gold is going up. It's not. It's really just that fiat is losing value. Although precious metals can go into a bubble, and they usually do. The swings down and up are always become overextended, right? And I guarantee you, gold and silver will go into a bubble, and that's also why it's the largest wealth transfer in history. Because there's nowhere else to run. Everything else is overvalued except for gold, silver, other metals, and maybe oil. But I'm not sure about oil because there seems to be plenty of supply as demand falls as global slowdown continues, right? But also the open interest and the manipulation, they can only manipulate prices so far. All right. I mean, everyone who screams manipulation, well, did they do it up until 2011 and 12? Because prices seem to go up, right? They could only do it when there isn't much interest in the metals, but eventually fundamentals and global macroeconomics will overrun the futures market, and so will the outstripped supply because a lot of the mining companies have stopped doing exploration. So, and they've cut costs by cutting production, right? So when metals are cheap, miners they cut their production, so they don't put as much metal out onto the market. Meanwhile, the central banks all around the world have been buying it up, and private individuals have been buying it up, all the gold bugs. And not just that, there's commercial use for silver and gold. And another way I know it's been the peak, right? So another way that I know we've hit rock bottom in gold a few years ago, technically it was back in 2015, and that's when I started buying, so I got it, or accumulating again. I I did sell in 2012. Recently, you've been seeing gold flakes put on food. Of course, the food's extremely expensive, and this is how you know we've hit peak in the markets, the economy, the business cycle, the expansion. When rich people, of course, the despair between the poor and the middle class and the rich keeps widening. But as of late, I've been seeing gold flakes being put on food, donuts, coffee, pizza. It's ridiculous. What a waste. And then they poop it out, right? But in recent years, I've been seeing this trend pop up. So, anyways, the open interest, a lot of the traders and speculators and the gold bugs always watch this. Whenever the typically when the speculators are long, that's the time to short. And when the speculators are short, that's the time to long. At this point, it doesn't matter. The speculators were right in the past few months, and I called it, right? And I don't know of anyone else who caught it like I did because of my technical abilities, right? My blue line, remember that 6 months ago? I'm like, listen, guys, this thing's gonna take off like a rocket. I mean, the beginning of 2019, I rushed my research report for you guys so we could catch it, right? And ever since then, it's been great. All right, so gold to silver ratio compression. When the gold to silver ratio compression, all right, so I talked about this, right? The gold to silver ratio. And I talked about how it magnifies gains if you buy silver when the ratio is way, way broadened out. Where when it's 80 or 90, right? The ratio. So silver back in the 70s when Nixon took us off in 71, it went up 1,811%. Gold went up about 600% in value. All right. So let's take a look. How did it do in 2008? Gold went up 77%, silver went up 371%. And this time around, at least another, couple 100% on gold, and I don't know about 1,000, but expect. Like I said, guys, watch that Mike Maloney video on silver. 150 is what I expect minimum, and then after that, I don't know. 300 wouldn't surprise me. Anything above it, I don't know. But let me explain why. Why would that be? And silver right now is only at like $16, right? So here's a chart. Total global silver supply decreased from 1,050 million ounces in 2014 to approximately 950 million ounces in 2019 estimated, right? Why is that? Well, for one, all the cheap and easy silver in the Earth's crust was already mined. And during the bear market, because of artificially low prices, the supply was sucked up by the market while it was cheap. And then exploration just stopped. So there's no new mines. Whatever's out there now is out there. Yes, there are some still doing exploration, but very few companies because most can't afford it. Only the large and junior size ones can, and then those small micro cap explorers all went out of business during the 7-year bear market of gold and silver, right? So it's because of industrial applications and renewable technologies. So your solar power and all that, and all the batteries and your Tesla and all this, guys, it all uses silver. All technology does. So global silver demand in 2018 is about 1,033 ounces a year annually, right? Well, so the supply has been dropping steadily, and it's going to continue to drop for I don't know, maybe it's just going to keep dropping from now on. And there's two reasons. one, it becomes increasingly costly to keep mining for silver unless you're a lucky mining company and you found good grade ore, which I will talk about later. But the supply's been dropping, and it's only at 950 million. And this is in 2015. It could be less now. Of course, you will see a spike in supply when prices go up, but eventually, because there isn't much gold in the world, guys, and all central banks have bought it up. So what is the middle class and the poor man's gold? I mean, it's silver. So silver is going to become a monetary metal again, like it used to be in the past. And for the U.S., silver was money. It was money for the British Empire, right, and all of the empires in the world, to the Roman Empire, all of them. Silver was a monetary metal, especially in the Roman Empire. The silver sterling, right, British Empire. It's a monetary metal. It's not just industrial. But the fact that it's both is going to create massive, massive shortage to the point where so much silver has been lost in the past few decades because of technology, your microchips and your computers and everything. It's all in the landfills. Of course, I guess eventually once the price is high enough, people will start recycling it, but that's that could be really long way down the road, 5-10 years from now. And I will look into a precious metals recycling company and their stock, but it's far off. No one's been even thinking about doing that. All right. So what's going to happen is corporations are going to buy silver in hordes, so they could sell their products. Like Apple's going to do that. Microsoft, IBM, like uh, what else? HP, Sony, Samsung. All your cell phones have silver in it. Everything that has electronics has silver. It's not just that. Silver is used in the medical field. It's used in there's an ounce of silver in every 4x4 solar panel. It's used for brazing alloys and soldering, which is welding, photography, electronics, of course, is 24%, 7.7% for renewables and solar panels. And this is 2015, so this has probably changed around, right? So I guarantee you, as world population continues to grow, and it will until estimated 2050, right? There's going to be more demand for silver as populations. More people are going to want cell phones and technology, right? Um, they're putting in 5G everywhere and this and that. It's going to take a lot of silver. Uh, your Bitcoin mining rigs, they need silver. All right, guys. Other industrial uses, right? For plant equipment, diamond drills, you name it. Did I just say diamond drills? That was wrong. Never mind. Um, Jewelry is 20%. Coins and bars. So the monetary, the financial, is back in 2015. It was almost at 18% already, and then silverware is 5.9%. During the Great bubonic plague, right? People who had silverware, they didn't get the plague because silver is micro uh, a micro by you guys know what I mean. It kills germs. And also, I mean, you could drink silver. I do. It helps with your immune and your gut and everything. And actually, there's been studies where it makes you smarter too. I don't know. Look into it. So I'm not making this shit up. All right. Silver demand will continue to grow due to its role in renewable energy, notably as key component in solar and battery cells for your electric cars, right? The smart economy that they're rolling out. It's all based on technology. It's all gonna need silver, Wi-Fi routers, you name it, right? Other renewable, I mean, cables, guys. Your look at the cable connections, your HDMI cables. If it most of not most of them, but a lot of the best ones are plated in gold and silver. They're the best conductor of electricity. So price of gold and silver as of late has obviously gone up by a lot. There will be a correction, I believe, when the stock market finally takes a huge dump. All right. So speaking of that, let's go and take a look at the charts, some macro charts, so you guys get a good idea of what I'm expecting. It could be wrong, right? No one's always right, and it doesn't exist. Especially, I mean, everyone thought they were right before 2008. Everyone thought they were right during the dot-com bubble, crypto bubble as well. Everyone, you guys understand what I'm saying. I like being a contrarian for that reason, right? So I like buying things that are out of uh, out of sight, out of mind, and not in favor. So here's a chart. Gold is the orange. The blue is the S&P 500. Just to give you guys a comparison. So as you can see, S&P 500 goes up, goes parabolic. Gold falls down. S&P drops. Short-term gold drops, but then it just starts rallying up and up. This is a 6-month chart. I could take it to a monthly. I just want to zoom out. Hold on. All right, here we go. As you can see, the divergence here. The green S&P 500 goes up, gold falls. Goes even higher, goes parabolic, gold falls more. Finally, it drops. We get a huge correction, which is, it's either a recession, depression, or you name it. And then gold rallies. And then here in 2008, it finally, we had the major recession, right? Dropped. Gold dropped initially for a few months, 6 months, something like that, 4 months, and then they started printing money like Weimar Germany or something, and boom, it took off, right? Now it went up with the stock market. I understand that. And that's why I'm warning you guys, we might get a stock market melt up. The problem with the stock market melt up is people think they're going to be getting rich off of stocks if this happens. I'm still not certain if this will happen, okay? But if it does, because Venezuela's stock market went straight up for a while, then it finally crashed once hyperinflation really took hold. But let's say let's say we get a decent drop in the stock market, right? The central banks panic. They start printing QE 4, 5, 6, 7, 8, whatever. They print like 20 trillion because they're going to have to print that much to reinflate the bubble. It takes even more to reinflate it, and then to keep it going up or from it crashing, you need to sustain it. It's ever increasing and it's compounding, right? It's how Ponzi scheme works. All right. So if you understand interest and debt, it compounds, and to keep something going up and up and up, you have to print more and more and more year over year over year. And as soon as they slow down or stop, that's exactly what they did in 2018, then the system starts cracking, right? All right. So, where was I? So, if the stock market, right, initially drops, they freak out, panic, print, and then it goes into a blow off top scenario, like a hyperbolic blow off top. So the green line goes straight up. That's S&P 500. Let me remove gold. So this goes straight up. Then, people think they're gonna get rich. The problem with that is there's two things, right? One is that means the dollar is crashing. So inflation is going to erode away your paper gains on stocks. Two, you're going to fall into there's tax bracket creep. So the more you make, the more taxes you pay in percentage. Unfortunately, the dollar is worth less. So let's say you work at McDonald's. You only make 20,000 a year, right? I don't know if they make that much. They probably do. 20,000 a year, right? And the dollar starts falling. So wages have to be increased by companies. They might not for a while, but they eventually will have to because inflation will run so high. So what happens is that McDonald's worker is going to end up making 60,000 a year or 80,000 a year. And this might take a few years. I mean, there could be one weekend where the dollar is cut in half. You don't know. It all depends on how bad things get, how quickly, and you just don't know that, right? It's an unknown. So, but what I'm trying to say is, a McDonald's worker could end up making 80,000 a year. Although that 80,000 will still be worth in today's purchasing power, right? Will be like 20,000. But they're gonna the tax bracket's probably gonna stay the same, and then they're gonna pay more taxes. So a McDonald's worker 5 years from now, 10 years, whatever, this is gonna happen quicker than people think. Um, I mean, we're already having some serious problems with the repo market right now. The canary in the coal mine, I think, has died. So things are gonna accelerate real quick. So let's say 5 years from now, a McDonald's worker is literally making 40, 60,000 a year, right? Well, in today's value, it's essentially 20,000, let's say. But they're going to have to pay higher taxes because the brackets are going to stay the same, if you understand. So that's the creep. Also, that reminds me, let me show you guys. What the fuck? Okay, so I wanted to show you guys this so you guys can understand how bad inflation has gotten over the years. These are the richest people today. Jeff Bezos, Bill Gates, right? And then you have Warren Buffett. Those are the known ones. Zuckerberg's seven. Jeff Bezos, I think it's more than 115 billion now. Let me check. Right. So Jeff Bezos' net worth is 109 billion. He just had a divorce though, In 2018, Amazon had 230 billion in revenues. Blah blah blah. He just had a divorce, so I think a lot of it was taken. Half. Man, she hit the jackpot, right? All right, so I wanted to show you this. Now let's take a look at let's take a look at the richest people in history, because it's not today's people, right? So you might think 100 billion is a lot for one person to have. Now, adjusted for inflation, though, they're not the richest people in history. All right, adjusted for inflation, and not just that. Back then, people paid a lot less taxes. The rich did. Although the rich were taxed the most back then, and those taxes fell down to the middle class over the decades. That's how it works. Like I said, guys, tax creep. So the dollar has lost like 99 or 98% of its value in the past 100 years. So the taxes that were put on the super rich ended up on the middle class. And this is going to accelerate really quickly towards the end. And we're towards the end of right now. And you can see 100 years of that tax creep in 10 years, in the next 10 years, happen. So let's take a look at the list. So these billionaires controlled a combined of 4.3 trillion. 4.3 trillion back then, or in today's money. The richest people ever are all men. Say, okay, 14 out of 25 people are Americans. Bill Gates is the richest American and the richest person still alive on this list. That's not true anymore. This must be old. It's definitely Jeff Bezos. All right. So number one is Mansa Musa. He lived from 1280 to 1337. That was a long time ago. And ruled the Malian Empire, covered the modern-day Ghana, Timbuktu, and Mali in the West Africa. Mansa's shocking wealth came from his country's vast production of more than half the world's supply of salt and gold. So this was an African, was the richest man in the world. Was it an Egyptian? I didn't know that. That might be interesting to look into for like a documentary or something. All right, so number two is the Rothschild family, of course, 350 billion. So Jeff Bezos right now is worth a little over 100 billion. They're worth over 350. John D. Rockefeller, remember that quote, that meme I showed you earlier? He was worth 340 billion. One person. So, yeah, the Rockefellers, guys. And the Rothschilds. They rule the world. There is someone behind all of them who has more right now, but I'm not talking about that. All right, so Andrew Carnegie, 310 billion. So these three right here, we're over 300 in today's dollar, 300 billion in today's money. That is enormous wealth. Enormous. I mean, with that much, you could do a lot. Just think of having just 1 million. Now think of having 10 million. 10 million, I'm happy, right? I'm set for life. Now 100 million, that's when you could start really screwing around. You could start looking at jets and yachts. Of course, planes and yachts are the quickest way to go broke. Islands as well. But then once you get into the billionaire club, which is 1,000 million, right? 1,000 million. Yeah, it's not a big deal to buy a yacht. You're not gonna go broke. But then you get over 100 billion. I mean, that's insane. For just one person to hand. This was interesting. Number 8, Muammar Gaddafi, 200 billion. And if you remember, he wanted his country to go on the gold standard. And what happened to him? Right. So Henry Ford was at 200 billion. Bill Gates is only number 12 on the world's richest adjusted inflation history, 136 billion. Anyone else? Sam Walton, Disney, was 65 billion. Warren Buffett is number 25, 64 billion. I am going to talk about a gold mining company, royalty streaming company, which actually has had better profits than Warren Buffett in the past 10 years, which has outperformed Berkshire and Hathaway. All right. Let's get back to the charts. I almost forgot to talk about this. So the macro trend cycle. This is gold. It goes all the way back to 1971. And you see this blue line, 1, 2, and 3. So this is the bubble chart. So you could draw lines. The beginning starts out with a 1, then you get a second wave, a third, and a fourth. And then you get a 5th down, a 6 up, a giant bull trap, and then a 7 all the way down to the ground. And a lot of you guys know where I got this from. But, I mean, it's just a bubble chart, guys. All right, so here's the 1, phase 1. That's when the market's dead. It's in a long-term bear market. It's consolidating for a very, very long time. For gold, it's since 1982 all the way until 2001. And this was the beginning in 2001 of a macro super cycle breakout of gold. And the second phase is possibly until the current. Well, the current is actually the beginning of the third phase. But the second phase was the entire bull run from 2001 all the way until the end of 2018. The third phase, we're possibly in the third phase right now. So where does the third phase lead? Well, the third phase starts going almost parabolic. But you get a nice breakout, spike up. And then finally you get the blow off top parabolic phase 4. And this will be caused by MMT, which is modern monetary theory, which is endless money printing like Zimbabwe and Venezuela and, Roman Empire, you name it. This has happened to every empire, every single empire. This is what they've done because it's the easiest route. Instead of the people with the village people with the pitchforks and the axes and the shovels coming and taking out the elite who've pretty much created all this with their funny money banking, right, and government, right. uh, instead of, having to face that today, they'd rather face it maybe not in their lifetime, or they'll push it off as far as they can. And the easiest route is always to print money for governments and, corporations and banks. It benefits all of them. In the short term, in the long term, next 5-10 years, what ends up happening is hyperinflation, and that's once, let's say, the left takes control of the power, right, the system. They're already talking about modern monetary theory, which is just money, endless money printing, giving everyone a welfare check, which is ridiculous. It's never going to work. You're just going to have hyperinflation. If everyone gets okay, think about it. Giving people money, is that going to fix anything? No. If you cut everyone a $10,000 check, what do you think's going to happen? The price of everything's going to go through the roof. And then that $10,000 check every month is going to be worth, like, I don't know, $100, really. So that's all that's going to happen. And it's really just a giant wealth transfer. It's the thing about the wealth transfer is who gets it first. So obviously, banks and governments get it first, right? All right. Now, where is the stock market? I believe the stock market looks a little different. It's this green line, right? Okay, so one was, it started breaking out here, like 1982. And then you could draw the second line here, third line here, and then I don't know. See, this is a little subjective. It all depends if we get a blow off top in the stock market. So 1, 2, 3, and then you could draw 4 going straight up, right? It's just that the lines move. I can kind of align it with gold. Look at that. A little bit. But you guys get the point. And again, let me show you how that looks on the bubble chart. So imagine 1 over here. This would be the 1 line, 2 line, 3 line, blow off top, 4 line, 5, 6, 7. And then it consolidates for decades. That's why I tell you guys, there's going to be a lot of fools when the stock market crashes by, like, who knows? God knows who knows. Actually, I was looking at that, and maybe I do know. But we'll talk about that later. But there's going to be a lot of fools buying down here, right? Well, first of all, the first bull trap is going to be up here. A lot of fools are going to buy that, and then they're going to get wrecked. But then a lot of fools buy down here. And guess what happens? It just slowly keeps falling for a very long time. And that's because it might take decades for the economies around the world, U.S. including, to recover from this. We'll see. That's why you don't want to, jump from the frying pan into the fire. All right, so Jim Rickards, and then there's a bunch of other people who've done the math. And there's different, it all depends on the scenario, how it plays out. But at current debt levels and monetary base, $10,000 gold could be the new gold peg and gold standard for the dollar. Once all the debt is wiped out and we've had the big correction and the smoke clears, central banks are going to go back to some sort of gold standard, right? Some new accord. Right, so here's the gold standard for the United States timeline. 1834, U.S. switches from a bimetallic gold and silver standard to a gold, fixing the price of the precious metal at $20 per ounce until 1933. Which would buy you a suit. Today, guess what? 1 ounce of gold could buy you a really nice suit. The Gold Standard Act establishes gold as the only standard for redeeming paper money, 1900. 1913, big day, right? That's when the Fed was created. Congress creates the Fed. European countries suspend gold standard during World War I, but return to modified gold standard. So when there's world wars, of course they're going to depeg from the gold standard, because that's the gold standard is the only thing that keeps checks and balances on the federal budget. But when there's a world war, they can convince the population that, hey, we need to print money so we can fight this war, so we can win it, so we don't, perish. Um, and that's how you get these modified gold standards over time and then eventually taken off. 1929, people hoarding gold during the Great Depression. The Fed raises interest rates, worsening the Great Depression and causing companies to go bankrupt. Which, that's stupid. Well, I don't want to get into the Great Depression, but it pretty much is playing out the same way as it is right now. The history books in schools are all BS, right? The winners always write the history. But the interest rates are going to go up despite the Fed. The Fed can't keep them down forever. The free market will force them up. And if the free market stops buying bonds, which is government issued debt, which is money printing, that's the same thing, guys. When they issue debt, when they issue bonds, that's when currency is created. You guys need to understand how that works. Anyways, but if no one wants it, then they go and buy it, and then the Fed will actually print money and buy U.S. bonds, and then just give the money to the government, and that's when you start getting the hyperinflation stuff. All right, and that was 1929. Okay, 1933, right? Great Depression. Run on gold reserves caused President Roosevelt to close banks. Banks reopened after relinquishing all gold to the Federal Reserve. Roosevelt orders Americans to turn in gold in for dollars, which creates gold reserves at Fort Knox. So the Roosevelt takes all the metals from the people, right? The poor people, gives them dollars, then they put it in to Fort Knox, and then the value goes up. And then they got their dollars that lost value. And that's essentially confiscation and stealing. The Gold Reserve Act prohibits private ownership of gold. Roosevelt increases the price of gold for the first time in 100 years. Like I just said, right? And that happened in 1934, a year later. Now, is this going to happen again? I don't think so. There's a lot more people, and people are much smarter because of the internet. And back then, people just went along and they trusted, their leaders. These days, we've been through enough. Humanity, we've seen enough, right? Although you could also argue that the sheep are more clueless and IQs have dropped. This isn't gonna work, and I'm gonna talk about if this does happen, what you could do. Obviously, the gold's gonna go up in value globally, so I don't think people are gonna put up with this. Another reason why they want to confiscate all kinds of things like self-protection. All right, 1939, the Depression ends and countries return to modified gold standard. And then in the 40s, return to the modified gold standard. Then we get the Bretton Woods in 1944. Set the exchange value for all currencies in terms of gold. Because U.S. holds most of the world's gold, countries peg the value of their currency to the U.S. dollar, not gold. And this happened right after World War II. So the U.S. got a ton of gold from European nations during World War II. And that is what the United States has been living off of ever since as the richest and most powerful country in the world. Now, in the late 70s and 80s, when Nixon took us off the gold standard, the U.S. dollar pretty much became pegged to like oil, which is the petrodollar from the Saudis. But that's depegged as of late as well, since oil prices are down. And now there's more oil coming from all sorts of places, and Russia, and of course South America has a ton of it, but because they're so corrupt and socialism, they can't refine their oil. Like Venezuela has the most in the world, and their people are starving. The U.S. no longer holds sufficient gold to cover foreign dollar holdings. 1970. So France wanted their gold back for their dollars. They want to exchange the dollars for gold, and the U.S. said no. That's why we came off the gold standard, because it would have broken the U.S. economy. And then, there's much more interesting historical facts. I don't want to get into that, but you guys get the point now. So mathematically, 10,000 very possible. Unless we get modern monetary theory, then who knows? Some people say 40,000. Here's the problem. I don't want it to get that bad, because at that point you're not looking at how much gold is valued in dollars. You're just looking at the weight. Eventually, so you don't want hyperinflation, because then you're just looking at weight, and the likelihood of you surviving is very low, because there's a lot of people, and a lot of people without jobs who are hungry and pissed is, a lot of bad things are going to happen. All right. Although, here's the thing, though. I don't think the system's going to, fall apart in 2 weeks. So, it's going to happen in years. And you could always take profits on the way up. And you could buy assets with them. You could buy a ranch. You could build your own wall. I don't know. You could, invest in becoming self-sufficient and self-reliant and protection. Build a community. Okay, so I haven't plugged myself. I need to, so I could buy more stocks and physical, right? Type in MMGinvest. My videos pop up. That's pretty cool. And then go to my website, and I show you guys a junior mining stock and some data and the things I look at and what to expect if you decide to join the private group, or we talk about, mining stocks. I share news events, breaking news on exploration and findings, and also I do all the data. The video will show you what to expect, okay? And then also I share my trades so you guys can learn how to trade. There is a basics to trading academy, and then I also share with you guys my indicators so you guys could use them for your own trading, right? The product pays for itself, and the goal is to survive and thrive, all right? I mean, that's what I'm doing. I'm sharing with you guys. Can't make any promises. I'm not a licensed financial advisor. This is just to help you with your own research, and then you decide for yourself, and you consult your own financial advisor before doing anything. All right, guys. So I do want to talk about something. There's a lot of gold bugs who are like, you can't buy stocks, only physical. Okay, why can't you just do both? Obviously, okay, if you believe that, then you buy more physical. Here's my own opinion about the physicals and stuff. For one, you can't keep a lot of physical at home because you're gonna get robbed. What are you gonna do? Some midnight gardening? Like, people have metal detectors, and when people are desperate, and if you told anyone, they're gonna know, and they're gonna find out and come after you. Your friends, your neighbors, So you can't keep a lot at home. Not just that, you never know if you have to leave in a rush because of an emergency. And if you have a ton of silver, you can't carry it around. What if you have to leave on it with a bug out bag someday or something, right? Or you have to get on a plane. They're not gonna. There's gonna be customs. They're gonna check. They're gonna take it from you. You can't get on planes or anything with coins. They're gonna take it. Although jewelry, like I said, in the links in the description below, bullion jewelry, and but you should have some. Now there's third-party risk, counterparty risk, right? If you have physical at banks or bullion banks, And you could do a domestic bullion bank, right? And I talk about this with my report and my data and all the information I share with you guys. I talk about that as well. The ones that I trust at least. And those are fairly safe. The fees are minuscule for security, the housing fees, storage fees. But can they get confiscated from there? Technically, yeah. I mean, what's the likelihood of that? Not much. Now, you could also do internationally bullion banks, right? And you could spread it apart in many. So if you spread it out, let's say, 20%, and you place it in 5 different places, obviously you need some money. At that point, you have money, right? You have a lot of weight. You have a lot of metal. Um, that diversifies your risk with physicals. It does. But you're gonna have to report it all, and there's paperwork. Although it's not that hard. Um, or you could do all of this, right? Have some at home, do some of that. There's gold money. I like that because you get a credit card or a debit card and you spend physical metal, but it converts to paper instantly. It's basically digital gold and silver. Um, I like that. But here's the thing. If the stock market, right? I understand the risk with the ETFs. The ETFs are just trading vehicles to accumulate more fiat. That's all they are. They're just for trading. There are some ETFs though that are physically backed. It's in my report. And there's a few ETFs that I do trust and have outperformed and will perform. Now, what are ETF? Exchange traded funds. They're baskets of stocks, and the metals ETFs are a basket of similar mining company stocks, right? Silver and gold mining company stocks. Um, in a way, there's a counterparty risk, right? But if these ETFs go down, now some of the ETFs will go down because they claim they're physically backed, but they're really not. Those I don't buy into, and I don't recommend them. But the ones that are really physically backed and the ones that just have mining stock shares, uh, if those ever go down, that means the entire system went down. And that means there's probably no food at the grocery store. And people can't get money out the banks. And civilization has collapsed. That's my own opinion. Because that means the entire market's frozen. And if it's frozen for who knows, like weeks over on end, then it's the end of modern civilization. You're not going to care about gold and silver that much. Well, I could trade it for food and this and that. Probably not. I mean, bullets at that point are the currency. So, I wouldn't worry about that. I don't think it's going to. I mean, there might be times where they freeze the markets and then they open them back up, freeze them, open them back up. But at that point, metals are just going to go limit up. And there you go. Also, the percentage gain and the leverage of buying miners ETFs and miners will be huge. That's what I think it will happen. I can't promise you guys it's going to happen, but I think that's what's going to happen. And then you could take profits on the way up and then go buy more physical if you can, right? Because at some point you're not going to be able to find physical. And at that point, the only place to go will be these ETFs and stocks. And then you could, if you can't buy metals, you could buy, like I said, go buy a ranch. I don't know, an apartment building, a house, a new car, things you need and want, and become self-reliant. I mean, at the end of the day, nobody really wants just metal. At the end of the day, you want things. You want to open up a business. You want to become self-reliant, own land, this and that. At the end of the day, you're going to convert that metal eventually, right? To food, to things, to live. You can't have just the love of money. So, I just want to touch base on that. Talked about confiscation. You know, some people think they could go and hide it in a lake. Like, you're going to put a weight on it, drop it in a lake. You think people aren't going to think about that? Like I'm saying, it's actually not that easy to hide it unless you live out in nowhere, right? That's probably your best bet. If you live out like in the woods and there's just so much land that no one's gonna cover it all. So then you could go bury it like a pirate. Now, what are the expectations holding physical? Like I said, 150 in my opinion for silver is very likely. So that would give you, that'd give you 700-800x, something like that. Gold, 5,000 is minimum, I think. 10,000 is a possible, yes. I don't know, guys. I really don't know how high it's gonna go. Hopefully it doesn't just go to 3,000. I'd be disappointed. I think 5 is a realistic number. So or higher. Now why do I think silver is going to go up so much? Like I said, guys, it's the depletion of the cheap silver. You guys need to understand that there's this thing called EROI, which is energy return on investment. So it costs a lot of money to mine metals. It costs a lot of oil, a lot of energy, a lot of labor. It costs equipment, right? That's what makes metals worth something. You can't make it. So there's articles that come out all the time with a stupid title or something. This says, all right, let's talk about portfolio management. On the left here, we have Tony Robinson. He engages in philanthropy. He's also one of those gurus on self-help, and he gives huge speeches. He's written many books. I've actually listened to many of his audiobooks. And on the right here, we have Ray Dalio. Ray Dalio he's the CEO of Bridgewater and Associates, which is one of the largest hedge funds in the world. Together, Tony Robinson went around and interviewed many hedge fund managers, and he did a special with Ray Dalio. I read that book. It's actually right up here on one of my shelves, up here on the top behind the Bear and the Bull statue. So, the all-weather portfolio. Now, everyone knows about this, and this is the portfolio Ray Dalio made to help your average retail investor manage their portfolio. He suggests 7.5% commodities, 7.5% in gold. That's actually a decent chunk of your portfolio. 30% into stocks, 15% in intermediate U.S. bonds, and 40% in long-term U.S. bonds. Now, textbook stuff, academia, school, it teaches you that the safest thing is U.S. Treasury bonds, right? Now, there's different types of bonds. There's REITs, there's TIPS, which are inflation-adjusted bonds. And TIPS might be all right. I'm not exactly sure on them. The upside potential on them, I don't trust the inflation statistics, and that's what these REITs and TIPS go off of. But that's for a whole different video. I personally don't trust bonds, okay? Because the bond market's in a giant bubble. Bonds, the prices of bonds have been going up for like 4 decades now. And we're coming towards the end of a huge economic expansion cycle. And what's going to happen is the interest rates on bonds are going to spike to the freaking moon, possibly, because the U.S. is in so much debt and the dollar is going to drop. So there might not be demand for bonds, and what happens is the interest rate goes really high up. Will it go high enough to offset inflation? That's the question. Because if you buy bonds, this is actually the risk involved, in my opinion. I could be wrong. The value of the bond could crash or fall significantly, so you lose money on your principal. But you could also, but then you're thinking, yeah, but I'm going to get a yield, right? The interest on the bond. Yes and no, because if the inflation rate is higher than the interest on the bond, and if the central bank had artificially suppressed the interest on the bond, or if the bond market ignores the Fed and the Fed loses control, it doesn't matter because you might get runaway inflation, then the inflation rate's higher than the interest on the bond. So not only can the value of the bond fall, but the interest on it might not outpace the inflation rate. And then you just lose money. A lot in two ways. So that is the risk I personally perceive with bonds. And that is a very bad scenario for the government and the economy. But I think it's very possible. Intermediate bonds, those are short term. So 30% stocks. All right, well, stocks, they might keep going up and we might get a blow off top, right? We might get a melt up. But it's a might. And it might be very short term, like maybe for one more year, maybe two, but eventually, eventually inflation and all the debt is going to cut into revenues, and the balance sheet of companies are going to start looking really bad no matter what. Over leveraged corporate bonds, banks, financials. Eventually the debt and inflation will eventually, in my opinion, blow up the system, and then your stocks are going to come down one way or another, especially with corporate buybacks. All right, so obviously I do agree with with commodities. So commodities is oil, copper, all the other commodities. Things you need to live, food, right? So some things might do all right, utilities might do all right, but demand usually falls when you have a global slowdown and a global possible financial reset, depression, stagflationary depression. Demand will fall, and it can fall for years. So commodity prices might actually fall. Now gold, that's different. He didn't even consider it within the commodity sector. Why is that? It's because it's money. That's why. It's an inflation hedge, and it's money. And if central banks and fiat gets pegged back to gold, like I said, there's been math done. 10,000 gold is very possible. And then just a 7.5% allocation in gold could save your entire portfolio if everything else crashes. That's why he put it in there, to save his own ass. I'm serious. You know what's funny? Like, over 95% of Wall Street and retail investors have like zero gold still. That's why so much money can flow into the market. Even though the gold and market's like 7 trillion in size, I showed you guys the world financial markets, all the debt, all the money in the stock markets and the bond market. It's over 200 trillion. So it's not going to take much for some of that capital to move into precious metals, to make precious metals go really high, especially if the futures market breaks up. Oh yeah, one more thing. I forgot to mention this. People always say, oh, they manipulate the futures market. Like I said, they could only do that temporarily, short term. the physical market, once the physical market, right? The physical spot market, the COMEX, breaks away from the futures, what ends up happening is the physical price keeps going higher despite the futures price. So everyone starts ignoring the futures price, the paper markets. And once that happens, you get this divergence and the futures markets break. And when they break, metals could go limit up, meaning every day, day after day, you can't sell your position, you can't buy your position. It just, metals keep going higher and higher every day. The futures going limit up means the shorts all get racked and squeezed, and the price just keeps going higher and higher and higher. All right? It's like a melt up in the price, and that's happened in the past. All right, let's get back to this portfolio talk. So Ray Dalio, as of late, Ray Dalio says the world is in a great sag and echoes the 1930s. So the Great Depression, the global market he's saying we're on the cusp of a possible Great Depression globally, a global one, because globalization, right? Everything's all right. He's also, in the recent weeks, said he's recommending larger allocation into gold, right? So a 10%. So he's saying you should allocate more into gold because of the geopolitical, because of the environment we're in. But he knows what's going on. I've listened to some of his stuff. He's been on podcasts, this and that. He talks about the things I do. He just doesn't, the way he words things doesn't set off alarms. You could use a high vocabulary to hide what you're saying, sort of, from your average Joe six-pack, but the smart people understand what he's saying. Alan Greenspan's been saying that as well. It's funny, after the Fed chairman, puts in his term, afterwards they start speaking more of the truth. But while they're the chairman, they don't. Because obviously if they do speak the truth, it'll cause a panic, so they can't. All right, let's get back to the portfolio. This is really important for you guys, especially the private members of MMG. So, okay, listen up. This is all up to you. I can't recommend that you take all your money and put it into physical metals and gold and silver stocks. I can't recommend that because that's insane, especially in the financial world. That's considered insane. You should never do that. You should always have cash. Should you keep it in the bank? Probably not, but under the mattress. You should always have cash in your brokerage account. You should have cash in your bank for, paying the bills and emergencies or whatever. But should you have stocks? Should you have bonds? Should you have a little bit of everything? Personally, I'm just going to tell you guys what I'm doing. What you should do personally is up to you after you do all your research. You're just hearing my perspective. Of course, always consult your licensed financial advisor. We're in that ISO'd suit down the street at your Fidelity branch or whatever. But this is what I'm doing and thinking personally. I'm not saying what I'm doing is correct. I'm not saying that I'm 100% certain, because I'm not. There's no such thing. But personally, I view stocks as overvalued, and I trade them. Sometimes I'm long, sometimes I'm short. But I don't hold them long. Like, I'm not just going to hold stocks no matter what, and hold them for the next like 10, 20 years. I think that's ridiculous. I think stocks are at a tail end of a super cycle of the longest bull market in history, and the stocks have been going up. It's the longest bull market in history. It's over 10 years now. Coming up. All right. So I might go long for the short term intermediate, but, I like to trade them. Bonds, I don't really hold any, personally. I don't see, I personally think there's too much risk for the upside potential. And they're already talking about 100-year and 50-year, and they yield negative, so why would I? Some people still buy bonds, okay? Betting on the fact that the value of the bond is going to keep going up. Or, I don't know, guys. I'm young. I'm in my I'm in my 30s, towards the beginning of your 30s, right? So I take on more risk. Although I feel that metals is the least risky thing right now, today. Now, 5 years from now, 10 years from now, it's going to change. I don't think the bull market in precious metals is going to last too long. But I'm willing to hold it, and I'm willing to bet that they're going to go up for the next 3 to 5 years. All right? So I have a lot of cash. I trade stocks. Now, this is how traditionally you would do it. So, and I'm going to talk about 401ks and IRAs and that, all right? So let's say you have $100,000, but you want to play it textbook style in whatever the Wall Street says and your academia says. So you have $100,000. So you would take, let's say, 10,000 of it and decide to invest it into stocks, gold and silver stocks, right? So how would you position that portfolio? Okay. Let's say you have $100,000 of investment capital. You'll take 5,000 and buy silver and gold with that, and then you want to take 10,000 and invest it in the stocks. So I drew up a little pie chart here, representing Ray Dalio's all weather, except if you were to take 10,000 of your 100,000 to invest in gold and silver mining stocks, you're not going to just take that 10,000 and buy one mining stock. That's ridiculous. You'll lose all your money. Or if you buy one of the larger miners, no, you probably wouldn't, but you don't want to throw all your eggs into one basket. And the upside potential of buying a large mining company shares, the upside potential is nowhere near what the smaller ones could provide. So to sort of diversify within the metals stocks, this is how I am playing the game. And I'm going to explain to you why. Now, I tend to take more risk, okay? So everything's subjective, and you could move around this pie chart, right? You might want to change the percentiles of the pie chart. All right. So I kind of look at it as 30% in cash and trading capital. So I will take maybe of this 30%, cut it in half. It depends on how confident I am of the trades I'm doing at the time. So everything's really subjective. And maybe 15% will be in cash, and the other 15% I'm trading with leveraged ETFs, or maybe not leveraged ETFs. And maybe a silver ETN. I'll throw in, I'll buy a leveraged junior mining ETF and a leveraged silver ETF. And I trade those with like 15% of this pie, this blue section of the pie. So 15% is always in cash for opportunities and other trades. The other 15% I will trade with leveraged ETFs, or maybe not leveraged ETFs. Depends how confident I am of the possible trade outcome. All right. And later I'll talk about stops and leverage and risk, being a risk adverse with your trading. All right. 40% I will just hold long with possibly maybe one or two large mining company, a few more mid-tier producers, and maybe a handful of juniors that have solid balance sheets, right? And have high reserves, so metals already in the ground, which they haven't extracted, but they know it's there. And royalty streaming. Now, royalty streaming, gold and silver mining companies are the ones that I think have the best risk to reward ratio. Meaning they have the least amount of risk, but they still have a lot of upside. Because usually, listen guys, you have to take a lot of risk to reap a lot of reward. Especially with gold and silver mining stocks. But with a royalty streaming company, you're actually, I believe, you have a lot less risk, but you have all the upside potential. All right. So most of my, not most of it, but a huge chunk of it is in royalty streaming, and I accumulate these. All right. Now I also have a decent chunk in the ETFs, gold and silver ETFs, mining companies, right? Now what's an ETF? It's a basket of mining shares of many mining companies. Now these ETFs are managed by other professionals, right? You're going to pay a fee for that because they manage them. And the fee could be, 3, maybe even 5%. You have to look at the ETF's fees. Preferably less than, 3% is great. Now, I picked the best ETFs with trusted managers with great track records, and I look at all the stocks they hold in their ETFs. They're publicly available. You can look at them. And I made a nice report for the private members where they could look up all the information on the ETFs. But I do hold long some ETFs, like about 4 of them. And these are non-leveraged. You can't hold leverage because you'll get wrecked, because it's a whole different video. But you never hold long for a long time, for years, a leveraged ETF, because there's huge fees on it and interest, and there's decay on it. You only trade leveraged ETFs. But I do hold long like 4 of them. There's also physically backed ETFs. There's one that I trust in the precious metals ETFs space. All right. But I do hold a decent chunk. Why is that? Because it's diversification, because you're holding a basket. So, there's usually like 30, maybe even 50 mining stocks in one ETF. And if 10 of them go bust, or 5 of them go bust, the ETF will be fine. It's still it could handle a couple of the mining companies going under, because the winners will pay for the losers, and you'll still see gains. But I like these ETFs because institutional money tends to flood into them because they can. All right. And then these ETFs issue more shares, and then they buy more shares of the mining companies. But I still buy individual mining companies, and sometimes they interlap. I'll hold a mining company, the individual stock, and then I'll hold an ETF which also has exposure to that stock of that individual mining company. All right. All right. So 7.5% in high risk junior and small cap producers. So you have your junior, your below mid tier, and your small cap, right? Which is like anywhere in the $100 million cap to $50 million, even down to like, I don't know, below $50 million market cap. Now, these are highly risky, all right? But I could handle putting 8%, something like that, into them, maybe even 10%. And I like to accumulate them now, not later, now. And why do I believe that's the smart thing to do? Because I want to accumulate shares. I'm not so much interested in the price. I'm more interested in the shares. Because if if these high risk producers could fix their balance sheet in a raging bull market, and we're going into a bull market, I believe, in gold and silver, and in the next like 6 to 12 months they fix their balance sheet, their stocks could really, the upside potential is huge because they've fallen from grace, from the 2011 2012 all-time highs by a lot, like 80%. So they have a lot to recover, and once their shares recover and they fix their balance sheets, pay off their debt. Obviously, I research into their balance sheets, right? And but you know, all their balance sheets look like they don't look good. But you know, I'm gonna talk about what to look for later. But if I pick the ones that look the best out of all of them, and they all look bad. All right, smaller the company. Okay, any of the juniors. Some of the juniors look good, but there's a handful. But all of the small caps, they all look horrible. But if I own like 20 small cap producers and just 3 of them pay off their debt and rebuild their balance sheet and have reserves, a decent amount of reserves within the ground, and they ramp up production, maybe they get a license from the state that they can mine. A lot of these are, have jurisdictions that are under review by regulators. And some of them, if they get approved, their stock explodes in price, especially in a bull market. I'm talking about 10, 25, 50x, 100x returns in a raging bull market. So I don't care, like, if I own like 20 of them and I threw a couple $100 into all of them, or, it depends how much money you have, right? If you're a millionaire, maybe you'll throw 1,000 into all of them, a couple thousand to all of them. And you're okay. You're okay with losing all of it that you put into small cap producers. So if this entire chunk of the portfolio goes to zero, I'm still going to be fine because the rest of the portfolio is going to do great anyways, right? So, but I'm betting on the fact that I throw a little bit of pocket change or a little bit amount, okay, into all of these junior and small cap producers, and let's say out of 20, just 3 or 5 actually make it. And so far they've survived, right, through the bear market, which is a good sign that they survived the bear market. And let's say they actually fix their balance sheet, pay off their debt within the next year in a raging bull market of precious metals, then the upside is going to be great. It'll pay for the losses of the rest of the juniors and small caps that maybe go bust. And a lot of these, what's going to happen is the larger mining companies are going to buy them out. That's what's going to happen. And before a buyout, usually the stock's going to rise, and then you're going to get the stocks, what happens is when they buy the company, your stock shares will transfer to the company that bought them. But before that happens, a lot of the times you'll see a huge rise in the price, a 20% bump or something. It all depends though on the buyout. If it's a hostile takeover, not so much. Depends on the situation. It's not always the case, so keep that in mind. All right. So I have a high risk tolerance. I'm young. I'm willing to do this. And it all depends on how much money you have as well. The more money you have, the more risk you could take. So if you have $100,000, you don't care if you throw a couple $100 into a micro cap. Like you're willing. So if you have $100,000 allocated towards gold and silver mining stocks, you might be okay taking $5,000 and just throwing it around in a bunch of micro cap and exploration stocks, and you're willing to lose that $5,000. Maybe you're really hungry for some. Maybe you have a really high risk tolerance and you really like gambling. You might throw 10,000 or 8,000 as lottery ticket, high risk, high gamble bets, right? So you might take like $300 and throw them around, right? Out of 10,000 into a bunch of micro cap, silver and gold, maybe micro cap producers or exploration, and you're helping out of like the 30 or 40 stocks you bought that just two of them or just one of them even explodes and makes it. And not just that, so if just 1, 2, or maybe even 5 do really well out of like 30, right? Those 5 will pay for the rest that went bust and will also make you a ton of money. That's what you're hoping for. Now, of course, you have to time this right. Now, let's talk about portfolio allocation and repositioning as time goes on. So this is, by the way, just keep in mind, guys, this is all based off the fact that gold and silver is going to rise substantially in the next 3 to 5 years. All right, that's what you're betting on. This entire portfolio. All right, this entire strategy is based off of that. Of course, if gold and silver tanks and gold goes below 1,000 and silver goes to $5, then none of this matters. This entire portfolio is going to get wrecked and destroyed, and you'll probably lose all your money and you'll capitulate, whatever. But this is based off the fact that the prices are going to go up for the next 3 to 5 years. I really have been studying economics and doing all this. I personally think it's going to go up. So I'm willing to do this portfolio and risk a decent amount of my money, right? Of course, like I said, you should always have cash. All right. Talk to your financial advisor and figure out for yourself how much you're willing to risk on gold and silver mining stocks. You really shouldn't risk anything you can't afford to lose. All right, guys? Because I don't know if the brokerage houses are going to go under. All right? That's always a risk. Like I said, it is a risk. And then there's windfall taxes. What are windfall taxes? Well, the government says you made a shit ton of money off the stock market crashing, and it's not fair, so we're going to take it. All right? And that's another reason why I do like stocks, because if I even get a hint of that coming down the pipeline, I'm going to sell my stocks. And then, I don't know, go to cash, buy some more physical. Go buy things. I don't know. You have to be flexible in this in a chaotic environment, and you never know what they're gonna do, right? Because in past history, I did that timeline of the history, and they didn't really go door to door, but you know what I'm saying. Like, you don't know what they're gonna do. All right. All right. So reallocating and repositioning as time goes on. So let's say some of your small cap and your juniors exploded in value. Well, what's going to happen? The 7.5 and the 7.5 is going to end up becoming maybe 40, 50, who knows, 70% of your portfolio because these exploded in value. You got a couple 50x, 25x, maybe a 500x. I don't know. You never know. Because I've experienced throwing, a couple $100 into something and it went up a lot. Like I've talked about this. I threw like $250 into a stock and it went to like 40 grand. And then it ended up being a much larger part of my portfolio. So here's the deal. I don't want, so if one of these micro caps or juniors or small caps explode in value, what I want to do is, you want to sell some. You want to take profits on the way up, and a lot of profits. You don't want to hold the smaller ones for too long. I'll always leave a little bit on the table, but, as gold goes up, in theory, right? In theory, if gold's going up, let's use the last bull market in gold, right? So I'm holding my micro cap and my junior cap, and the market goes into a raging bull market. Now, the micro caps, the smaller the mining company, the smaller the market cap, especially for explorers or whatever, those go up in value later in the bull market cycle. They don't go up now, but they do go up slowly with the market. So I like to accumulate early, not later, of everything, especially royalty streaming and junior. And I do want to buy my high risk lottery tickets now, not later, because now you could get thousands of shares for like a couple $100. And those shares are going to go up on no news during a bull market because a lot of people do that. They just buy across the board. Some of these might end up going into ETFs, and then when people buy ETFs, the ETF, the fund, buys shares of the company. That's how it works. So that's why it's so crucial to accumulate now, not later. Well, the time was to accumulate the beginning of this year, and that's why I was screaming buy now, not later, because you're going to get pullbacks and corrections, and people are going to freak out with their emotions. All right. So I accumulated about all my stocks down here, right? I was the smart money. Well, your micro cap and your juniors and your small caps, they usually really start taking off later in the game. And when they start taking off in a big way and you're seeing huge gains, like huge, you're going to want to start taking off. You start scaling out of the position. And what I do is I sell those riskier ones that really took off like a rocket and had massive gains. And what I'll do is I'll sell them, I'll raise cash, and then I might reallocate. I'll reallocate into the larger mining companies and possibly into a little bit more into ETFs and especially the royalty streaming companies. So I'll take profits as these grow in cap weight in my portfolio. I'll take profits, scale out of the riskier ones as they go up, and go into the more less risky ones, right? So that's my strategy. But of course, you have to buy the risky ones now, and they're probably not going to do anything for a while. They might go up slowly, just creep higher and higher, but I want to accumulate shares, okay? But still, I don't invest much into these. At most, 15%. If you have a really high risk tolerance, 20%. of the entire allocation portfolio into gold and silver mining stocks. I wouldn't go past 20. 20 is pretty risky, but I'm confident the ones I've researched, and if they could just survive the next 6 months, they just have to survive. The worst case scenario is they get bought out by a larger mining company, and then you're just going to get shares of that company. And then you could decide if you keep those shares or you sell them. All right. Just be prepared. A lot of the micro caps, explorers, and the juniors down here, some of them are going to go bust, or a lot of them are just going to get bought out. All right. So you're betting that, out of like 50 high risk stocks, 5 or 10 of them, let's say out of the 50, let's say a good case scenario, 20 of them survive and they all go up in value during a raging bull market. And then out of that 20 that survived and went up, 10 went up in a big way. And out of that 10, 3 of them just exploded in value, or just 2 of them. Or you'd be happy even with just 1, all right? So that's how I look at it. Now, for the professional traders, you could hedge against this entire portfolio by... I don't suggest going short. Short is very risky. Going short is... Most people who are short side traders, they lose all their money. Why is that? Because going short, the risk you're taking is very high compared to the reward. Going long is always less risky and with a higher reward ratio. All right. So, for example, let's say, so gold went up from $1,000 to $2,000, right? In 2011. Well, it went to 1900. So it fell 70%. All right. So if you shorted it at the top, you made 70%, but it took a very long time. It took a few years. But while it was falling, you had huge spikes back up. And if you're using any leverage, you're just going to get stopped out. And then, shorting, there's fees involved with shorting as well, short interest, right? Now, the long side, when you go long, there's just unlimited upside potential. When you go short, there's unlimited losses. So your account could go negative if the price goes against you and just keeps going up and up and up and up and up. So shorting gold and silver, I highly recommend you never do that because you never know. And especially in the next few years as things get crazy, all right, with central banks. But you can hedge by going long with inverse ETFs. This is also very risky. I always use less money to put on a hedge than I do when I go long, all right? But that is pretty much a separate video. Obviously, you will have to use stops, and I'm going to talk about that later, all right? So this is pretty much the portfolio I like to look at. It's pretty much the Ray Dalio portfolio, except only for gold and silver mining stocks. Okay. Now, that doesn't mean that this is all your money. You can still have stocks and bonds and all that. So this is, let's say you did hold stocks, bonds, but you wanted to allocate 15, 10, 20% of your money to just gold and silver mining stocks. Well, this is how you might want to allocate your portfolio. and then you would have to adjust it, reposition it as the bull market matures with time, right? And then as the bull market keeps going, right, you're going to want to sell on the way up and just raise maybe cash or buy things like homes or buildings or, I don't know, fund a business. Up to you. Buy a car. Buy more physical. You scale out on the entire way up, slowly but surely. All right? I like to draw like a pyramid for scaling. Scale out. Well, for the price going up, this is what I do. I'm just telling you guys what I do. So the price is going up, right? Right here, right? What I like to do is the pyramid on the way up. So I scale out a little bit. Here, scale out more here, scale out more here. Start scaling out large amounts towards the top. Of course, you don't know when's the top, right? When you're in it, because you don't know how big a bubble is, how big a bubble is going to get. Usually when it's gone hyperbolic vertical, like 90 degrees straight up, you know it's probably the top. All right? That's all I have on that for timing the top. I've been pretty lucky timing the top, or maybe it's skill. Maybe it's a combination of both. Hopefully, I'll definitely get the next one. Either way, I'm going to scale out some on the way up. That's pretty much all I have right now for this. Now, exploration companies, what are those? They explore. They don't actually mine anything. They just look for deposits around the world. And when they find one, they might want to try to build a mine, or they sell it. They usually sell it and cash out. And these things, like, they will go from their stock value being almost nothing to exploding. And these are super risky. This is like playing this is like playing roulette. And it's very risky. The odds of exploration companies finding anything is like very small. But some of them do, and you might get lucky. I really don't throw any money into these. I might have a few, but the only ones that I really like are the ones that have like, are the big ones, are the large exploration companies that have like 5, 7, 10, 15 sites, and there's already known deposits. Those are the only exploration companies I'd even look at. What I do like risking money with, or risking money to invest, are the ones that are exploration and producers. So they have a producing mine, a healthy balance sheet, a decent amount of reserves, and they have a bunch of sites that they're exploring, and they've already found deposits, and they're still risky though, all right, because they're spending a lot of money on exploring, but a lot of them come up empty-handed. All right, so that's really risky. Never throw, like, pocket change, guys. Pocket change. You throw into those. My favorites are royalty streaming. I'll talk about that in a little bit. ETFs, I like them. The large mining companies, I mean, if they're royalty, they have a lot of royalty and streaming. I like them. But the upside potential, I mean, it's still going to be great. Here's the thing. The junior producers, the ETFs, and the royalty streaming with decent sized market caps, like preferably above 50 million. I mean, preferably in the bill. I don't know about billion, but a couple 100 million and up. That's a decent size producer. And the royalties, I mean, it could be $1 billion, right? That's fine. But those are my favorites. Less risk, but decent amount of reward. And institutional money, hedge fund, even pensions could go into these. So they could receive a lot of capital. Now, these little companies aren't going to get that. What they're going to get are the gamblers, the speculators, and the retail investors that are buying penny stocks, essentially, pink sheets. And they're always on the OTC markets. All right. Always have cash on the sides. Trading. You shouldn't trade unless you have like many years of experience. I'm going to talk about that later. Hedging. You need experience trading to hedge. All right, guys. You should do cost dollar averaging. Now, listen, if you're a noob to investing, you have to realize that precious metals, gold and silver, in these mining stocks are extremely volatile. And we're still in the beginning stages of the game, so it's going to be very volatile. Also, if the stock market does dump, and eventually someday it will, when it dumps, the stock market, guess what? Gold and silver dumps, and the mining shares, they also dump. Well, they may dump. I don't know if they'll dump this time, but they did in 2008 and 2009. And that's why I'm warning you. All right. Here's 2009, 2008 mortgage-backed security crisis. As you can see right here, metals initially went up when the market first started falling. But then once it kept falling and falling, then margin calls, the hedge funds, everyone got a margin call, and they hit the button that sells everything, including all of their gold and silver mining stocks, futures, everything, and then metals tanked with the stock market, and then metals went up. Will that happen again? Probably. It might not, though. I don't know. I'll know hopefully when we get there. And it might be soon. So next few weeks or months, it could happen soon. All right? Or it could happen a year from now. I'm not a prophet. All right? Let's talk about royalty streaming mining companies. All right, first of all, royalty streaming mining companies are kind of like loan sharks. They don't run, well, they can be on the boards, they can give advice, but they're not like a mining company. What they do is they lend money to mining companies, and in return, they have revenue sharing. And they could also have delivery of actual physical metals. So, and there's interest on the loan. But they get a percentage cut of the mining company's revenue. So if a mining company finds a nice vein and good grade ore, and the mining company's market cap explodes and it's worth much more, what happens is the royalty streaming company gets a percentage of the gold they even discover, and they essentially get the revenue. They don't take any of the profit. It depends on the contracts. All the contracts are a little different from one another. So, it's, you have to look at it. But these royalty streaming companies, they have they have many contracts with many mining companies. And depends how these royalty streaming companies are ran and who's running them. But if the royalty streaming company knows what they're doing, right, and they have the best analysts and good whatchamacallit, not scientists, but geo uh, engineers, and they could look at the balance sheets. They could look at the grade of material, what kind of mine it is, if it's an open pit, if it's there's just straight drilling. They look into the companies, and if they like what they see, then they will give a loan or go to the company and offer them a loan so they can maintain the mine and continue operations, and then they benefit no matter what. A lot of them look to take advantage of the cheap gold and silver prices. So these royalty companies, not all of them, but a lot of them, they pay dividends. All right. So if the mining company, isn't really doing well, they still have to, under the contract, pay the royalty company. Now you might wonder, well, will this put the mining company, which took the loans from the royalty company, will the royalty company put them out of business? Well, they tend to be lenient because it's a cash cow. So these royalty companies, them in themselves, are like the goose that lays the golden egg for an investor. But these mining companies are also gooses that lay golden eggs for the royalty company. So they don't want to kill the goose, okay, that lays the golden egg. So they might lean a bit off, restructure the loan. They might restructure the contract to keep the mining company somewhat healthy and maintain it, so they can maintain it and keep it running until the next bull market. And that's the name of the game for these royalty companies. It's to help these smaller producing mining companies stay in business. But when they do start making profits eventually in a bull market of gold and silver, the royalty streaming company is going to take huge chunks of that profit and revenue. And that's why there's virtually, I'm not going to say there's none, there is, but there's much less risk to a streaming royalty company. Why is that? Well, one, they don't have to maintain a mine. There's depreciation on equipment. A lot of these mining companies lease the land from states, right? A lot of them, you don't have to pay employees. They have very low overhead. The streaming royalty company, it's like an office, okay? It's like a hedge fund. So they don't have to deal with all of the downside risks of mining, because mining is extremely expensive. There's so many risks involved. Geopolitical, you could get regulatory risks. You could get, there's risks if you pollute the water or the river nearby. You also get the regulators and the environmentalists can come and attack you. Depends where the mine is at, right? Located geopolitically. And I look at the stuff like that. If it's in a region where the government may nationalize the mine, right? That's huge risk. I mean, if they nationalize, they just take the mine. They take your company away from you, basically. There's tax risks. There's fees. There's all sorts of, so many risks. Mines could flood. There could be a earthquake. You never know. Maybe they thought that they found a huge deposit and it ended up being something else. I don't know. Although technology has definitely advanced for exploration, and that's a good sign. That's a good thing for the entire mining sector. All right. There's risks with roads, electricity, because you need power, right? And if the mine is located out in the middle of absolutely nowhere, um, you have to run lines to it, power lines. You need a road. You need water source, right? You need some of these mines are in the north, right, in Canada, where the weather makes a huge difference because costs could go up due to the weather. Another volatile cost for mining companies is energy costs, oil for drilling, uh, electricity, all of it, right? Another cost, huge cost for mining companies, is the employees because they have to move to wherever the mine is. And usually, a lot of the times, these mines they're not near, cities, and they could be out in the middle of nowhere. The Australian mines, I mean, a lot of them are just out in the desert. A lot of the employees at these mining companies, I mean, the living quality is horrible, so they get paid six figures to work there, right? Um, so there's a lot involved, guys. Again, the volatility of gold and silver, it could wreak havoc on a mining company's balance sheet and earnings reports. Okay, and these mining companies have a hard time hedging against the price volatility. So even when the price is going up, some of these mining companies, they don't go up, and that's because they report poor earnings. Some of the things I like to look for is if during the bear market they have a lot of cash on hand and they cut production, but they have a ton of reserves in the ground and they're holding those reserves for the bull market. That's a sign of strength, okay? What else? Robust uh, margins, right? So you really have to, one of the most important things you have to look for is maintenance capital expenditure. So just to keep the freaking company alive during a bear market, what's the cost of just maintaining the entire operation, right? Uh, you have to look at the margin costs, right? EROI, energy return on investment. So your ore has to be decent quality ore for the amount of energy you're wasting to extract it from the ground. Um, and then you look at the financials. All right. So I use a lot of software to help me makes things go much quicker, right? And there's a lot of things I look at, a lot. Um, all right. So what do I look at? Of course, you look at the market cap, shares outstanding. You want to look at All right, let's get into it. This is Franco Nevada. It's one of the large ones, right? So capital flows. You want to look at the history of the price, P ratios, basics. Future cash flows, current cash flow. Is there healthy cash flow? Is it liquid? Of course, you want to look at the debt outstanding. You want to look at earnings growth, revenue growth. Now, of course, a lot of the balance sheets and a lot of these numbers look really bad for most of the mining companies because it's just coming out of a 7-year bear market. So what I like to see is growth overall during the bear market. Like things are getting better during the bear market, slowly but surely. It's a good sign across the board for everything. All right. So earnings, cash flow. Uh, I'll show you guys some more in depth in a second. Past earnings, this is just a quick, brief oversight. So net worth, it always needs to be much larger than the liabilities, right? So this looks great, right? 4.8 4,800, so 4 billion, 4.8 billion net worth versus liabilities, right? Liabilities are much smaller. Long-term liabilities, only 356 million. Liabilities short-term, 202 million. Assets long-term, 4.8 billion. Assets short-term, 540 million. Also, I like to see asset growth. If they're buying plant and equipment, that means that they're getting ready to drill deeper, and maybe they have, you also want to look at if they have new discoveries, and of course the reserves in the ground that's known. And then there's estimated, and then there's what they're hoping for. They fluff it up a little bit on their newsletters and emails. All right. Cash, short-term investment. You want to see some, but not too much investment. Inventory, very, very important. So receivables versus I'll talk about that in a second. Now, what I don't like seeing is them diluting their shares, meaning they issue more and more stock shares, or they keep doing a bunch of stock splits, and then they dump a bunch of shares, and they're selling. Insiders are selling. My software could tell me if insiders are selling, by the way. Total compensation. I mean, if compensation's growing, I guess it's healthy. Although I don't like to see greedy CEOs. All right, so I like to see when there's more institutions investing than the general public. That's always a good sign. But I also like to see insiders have a decent share of the company. This is a very large company, and it's had a decent amount of turnover, I guess, over the years. Big companies have that. So the larger the company, of course, the share of the insiders share of the company is smaller, okay, generally. And you always want to see more buying than selling in recent times. All right. Here's Caterpillar. Of course, I look at the news all the time, and I keep you guys updated on the news in the newsroom for the private group. So there's price versus fair value. I mean, these projections, they don't really mean much because they don't consider future growth. Trailing returns. I like to see trailing returns growing over the years. So financials, right? I dig deep into the balance sheet, into the income statements, cash flows, all the whole shebang. And then I color coordinate. If it's green, that's good. If it's orange or red, that's bad. Warmer the color, the worse. Green is better. Blue is sort of neutral. So you want to look at the EBITDA. That's what I like to call it. That has to look good for stocks. Valuation. Price earnings ratio. You want to see that go higher. Enterprise value. You want to see that stay steady and growing. But the enterprise value, EBITDA, you could go to Investopedia, look up what that is. That I need to see growing. That's very important for the price of the shares. But operating performance, right? So that's what I was talking about. Maintenance capital expenditure. You want to see operations growing and growing. So return on assets, you want to see that growing. Return on equity. Of course, in the bear market, it was negative. You want to see it coming out of the negative territory. Return on investment capital. You just want to see everything growing. So net margin percentage and operating margin percentage. Days in inventory. You don't want to see inventory sitting. You want to see it moving. And you want to see it selling. You want to see, the turnover grow. Inventory turnover. Sign of healthy market and the sign of healthy company. Dividends are always a plus because you get paid as time goes on, right? So dividends are always great, guys, for the long term. By the way, if you sell a stock within a year or within, you're going to pay capital gains tax. So the name of the game is whenever you go long, you plan on going long for a long time. So as soon as you sell and you take a profit, you're going to pay capital gains. And you can only declare like $3,000 in losses. So why isn't it loading? So I like to see some of the best hedge funds and profitable ones buying, right? And you can see who's buying, and I like to see them have a large percentage share of the company. You could also see if they're selling. You can see who's buying, who's selling. So you want to see the best hedge funds and the best ones with the best track record buying, not selling, right? And for the smaller mining producers, the more institutional money that's investing in it and the more percentage share they have, the better it is. And it's a good sign if a small mining company actually has institutional money investing in it, even if it's like just a few million. I mean, someone looked at it and they said, hey, this is good. That means later on they might invest more. And then I'm not the only one who sees this. Other institutions see it. They look at each other, what they're doing, and then they'll go research it themselves. And that's what I do. All right. So yeah, I mean, listen, guys. I pretty much covered, I think, everything you guys need to know. I mean, with streaming, okay, so here's how you could look at it. With royalty streaming companies versus ETFs and just producing mining companies, right? You don't have risk to capital costs. You don't have risk to maintenance. You don't have all those risks I was talking about. You have all the upside. Institutional money likes them, and they could actually perform well in a bear market. Franco-Nevada did. All right. Now there's a bunch of other royalty streamings that they're down by a lot from the all-time high, but I think they're going to do pretty good if gold and silver go into a raging bull market, right? Even if they go to 3,000, I mean, it's probably going to do great. So it's pretty much what I wanted to talk about. Let's talk about a few more things that I haven't, which I might have forgotten to cover. I have my notes here. So let's see what else. Producers always need capital. They always need to upgrade, maintenance, regulations, land leases, explore, shrinking profit margin, cost of labor. By the way, they have to constantly dig deeper for metals. So there's a handful, guys, and I found a few. I'm really excited. I think these are going to be like life-changing stocks. I just posted one a few days ago. There's a few producers as of late that found high grade, high or large amounts of gold and silver, and they're good for the next 10-15 years of just producing a ton of gold and silver. And the shares of their price, the share price hasn't like exploded yet. I mean, it's gone up, but there's way more room to run. Fingers crossed nothing goes bad with the jurisdictions and everything else. They look great. I'm willing to throw some decent chunk change at them. And they're small. They're actually small right now, but they have the room to grow into a junior or mid-sized to maybe large in the next 5-10 years. So good stuff. Geopolitical risk, nationalization, the location, roads, water, power, environmental impact, high employee contract, research and development, which is exploration. R&D is for tech companies and everything else in the stock market. Stock share dilution, splitting. These are things you guys need to keep in mind. So yeah, the royalty streaming companies could always amend clauses to keep their investments in business. They don't want to run the mining companies out of business. Recently, one of the royalty streaming companies bought a producer. I'm not sure if it was a takeover. I forgot. So some royalty streaming companies might dip their toes into producing as long as they make the right decision. It might be a great decision, or it might be a really costly decision. Either way, I think it might have been a good one. Management is key, and it's hard to know and hard to find who's good management. There's a handful of them, and we all know which companies they run. But, that's the part that I lag in personally, because who has the time? I don't have a team of analysts to look into this. It's just me. But I do know just from listening over the years who runs who has a good track record. And I also know which hedge fund manager and ETF owner picks some of the best mining stocks, all the way from royalty to junior to microcaps. So I know who he is. I look at what he looks at, and then I do my own research on it because it's all public. So yeah, I think I covered everything. Now check this out. For those people who say that you're going to be able to make gold and silver, no, you're not. Not ever. All right? There's pictures of alchemy. You know what alchemy is? It's the process of trying to make gold and silver. That's where it came from. And then they turned into, weirdo cults. Listen, guys. You can't make it. Why can't you make it? My next video this weekend, I'm going to make a video talking about it. You can't mine an asteroid that's flying by thousands of miles per hour. No way. It costs way more just to put like a pound in space. It costs like 40 grand just to put like an ounce or something in the space. You think they're going to just like fly to a speeding comet or asteroid, mine it like a bajillion miles away, and then fly it all the way back with a bunch of jet fuel and then somehow land it onto Earth without like blowing the Earth up? Because it doesn't take a large asteroid hitting the Earth to turn us into the dinosaurs. So, or to go the way of the dinosaurs. Listen, no one can make precious metals. They can make fake diamonds, but not gold and silver. So alchemy, it's been tried for thousands of years. Still don't have the tech. And I still don't think we will in our lifetimes. All right? And why is that? My next video, I'll show you why. All right. So this was a long video. If you made it this far, congratulations. Hopefully my private members made it this far. They should, so they know what they're doing. And if you made it this far, I really hope you learned a lot, and that's why I'm here. Smash some likes. I really appreciate it. It helps my videos. And leave anything in the comment section. I'm sure I screwed something up. I'm pretty tired. I've been up for like 24 hours. I'm sure someone's going to make a comment about it. But, you know, give me your opinion. That's fine. I'll comment on it. Comments help my channel grow and my videos, you know, get some trending. And go to my website. And please share my videos. That means more than anything, guys. It's the only way my channel grows, and I'll continue to do this. And please refer back to this video when you have questions. Hopefully people in the chat groups will stop asking me questions now that I've covered a lot. I did forget to... I will make a video on trading, alright? I'm just going to keep that separate for now. Until next time.